Welcome back, Focus Learners. Today, we're unpacking a truly historic milestone in African private equity. Now, if you follow global capital flows, you already know that moving large sums of money in emerging markets is never just a simple transaction, right? It's this intricate dance of strategy, relationships, and deep market knowledge. Well, today we're looking at a completely groundbreaking move by Johannesburg-based Sango Capital. They're quite literally unblocking the financial plumbing of an entire continent. So get ready because the implications of this deal are absolutely fascinating.
Here's our roadmap for this explainer. Think of it like an iceberg. We're going to start right at the tip with the headline-grabbing transaction, the $120 million milestone. Then we'll dip below the surface to understand the African liquidity problem, explore Sango's competitive advantage, and finally look at the future of African capital.
Okay, let's dive into this. Section 1, the $120 million milestone, Africa's largest private equity secondary deal. $120 million. That's the exact net asset value across 4 African private equity funds that Sango Capital just acquired. And what makes this exact number so monumental? Well, it's the largest documented secondary deal in African private equity history, period. This massive portfolio was acquired from a non-African institutional investor who's looking to rebalance their global allocations away from the continent. But as you can probably guess, executing a deal of this massive magnitude isn't just about writing a big check.
Just look at the scale of this thing. This single transaction encompasses roughly 30 underlying companies spread across 14 different African markets, originating from 4 distinct private equity funds. It's like a giant multinational puzzle. And incredibly, Sango solved the whole shebang off-market in just 3 months. 3 months. Even crazier, they financed this using a mix of their own balance sheet and fresh commercial capital. They actually brought in US-based family offices who are making their first ever allocations to African private markets. That is a real game changer.
And what's really fascinating here is the incredible economic footprint this gives to those fresh commercial investors. We're talking broad, diverse exposure across financial services, consumer and FMCG, infrastructure, and light manufacturing. So instead of betting on a single company or just one country, this massive portfolio offers a uniquely broad slice of continental economic growth.
Which brings us to the underwater part of our iceberg. Section 2, the African liquidity problem and why financial plumbing matters. So why exactly is a $120 million deal like this so historically rare in the first place?
Let's quickly de-jargonize this term. The secondary market is basically just the buying and selling of pre-existing investor commitments to private equity funds. Think of it as the essential financial plumbing of the investment world. When an original investor wants to cash out early, they sell their stake on the secondary market. But if the plumbing is blocked, meaning, there's nobody there to buy those stakes, investors get trapped. And obviously, if investors know they can't get their money out easily, fresh capital absolutely refuses to flow in.
To understand why those pipes have historically been so backed up in Africa, we gotta look at the historical reality. For years, African funds were heavily dominated by development finance institutions, or DFIs. Now, DFIs are generally pretty reluctant to sell their positions early. They hold on tightly, which unfortunately suppresses secondary market activity. So what we're witnessing right now is a massive structural shift to a totally new dynamic. The exit of a commercial institutional LP from 4 funds simultaneously, that proves commercial capital is finally stepping in to clear the pipes.
But let's be real, there are 3 distinct structural hurdles that make clearing those pipes incredibly difficult in Africa. Number 1, geographic complexity. Navigating the legal and financial frameworks of 14 different countries simultaneously is a total headache. 2, relatively small ticket sizes by global standards, meaning massive global funds often just don't think the effort is worth their time. And 3, limited information availability. Historically, these 3 massive hurdles have kept global secondary giants like Ardian entirely away from the continent.
So how exactly did Sango Capital conquer these massive structural barriers? Let's move to Section 3, Sango's competitive advantage, turning barriers into opportunities.
Let's bring in the human perspective here. Richard Okello, co-founder of Sango Capital, hits the nail on the head. He says, this transaction reflects everything Sango has built over 15 years. The analytical depth, the relationships to source off-market opportunities, it's literally those deep 15-year relationships with local general partners that allowed Sango to intimately understand and underwrite this super complex portfolio when outsiders simply couldn't.
Sango essentially flips the script. They turn Africa's geographic complexity and limited information into a localized competitive advantage. Because they have a decade and a half of on-the-ground operational experience, the exact hurdles that scare away the global giants are the moat that protects Sango. They've built this execution capability that simply cannot be easily replicated from an office sitting in New York or London.
So the crucial point is exactly what Sango co-founder Charles Mwebeiha notes here. Global institutional investors have long cited liquidity and exit concerns when looking at Africa. But by stepping up as a massive secondary buyer, Sango is actively delivering the exact exit solutions that global investors have been desperately waiting for. They're proving for sure that you absolutely can get your money out of Africa when you need to.
What does this mean for the road ahead? Let's look at Section 4, the future of African capital, a pipeline of growth.
Let's move to and see how this builds out into the future. This $120 million landmark deal, it's really just the beginning of Sango's pipeline. They've already signaled that future transactions are expected to be 2 to 3 times this size, potentially soaring well past $200 million in net asset value. They're not just clearing the pipes once, they are widening the entire infrastructure for future flow.
So, let's summarize the macro takeaways we've unpacked today. First, Sango is now managing roughly $1 billion in assets, which totally cements their first-mover advantage. Second, their institutional capital base is actively expanding, bringing in those brand new U.S. allocators we talked about. Third, and this is absolutely critical, this entire deal validates Johannesburg's credible capacity to originate, underwrite, and close highly complex pan-African financial transactions at a true institutional scale. And finally, it sends a bright, flashing signal to the global market that Africa's liquidity infrastructure is finally maturing.
Which leaves us with this final, massive question to consider. As Africa's secondary market matures and these multi-million-dollar liquidity solutions become the norm, is Johannesburg becoming the undisputed hub for Pan-African capital? Sango Capital's historic transaction suggests the answer might just be yes. Think about the long-term geopolitical and financial impact of that shift. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll see you next time.